For today's presentation, I'm going to be talking about the truth about annuities. And the goal of today's presentation is to talk about annuities at a 30,000-foot view. What I'd like to do is really uh, uncover the myths and misconceptions that people have about annuities. It tends to get a lot of bad press out there, but the fact of the matter is there are a lot of people who buy annuities, and they're buying them because annuities do a couple things extremely well. In fact, they do these things so well that no other financial product can even come close to providing the same type of guarantees that the right type of annuity can provide. So down in the bottom right corner, you see that's my photo. I'm the owner of JLM Wealth Strategies. I've been in the business for 20 years, and my focus really has been on safe money solutions. And if you have the right type of annuity, that definitely counts as a safe money solution. So let's jump into it. Now, you may be familiar with the name Jeremy Siegel. If you aren't, he is the professor of finance at the Wharton School of Business, one of the top business schools in America. He is a frequent guest on a number of different shows. You can see his photo here from CNN Business. Here's what he had to say about annuities. Annuities have a primary role for the future retirement income. And what he's basically saying is that if you've done a good job of accumulating assets, you've reached a point in your life where you need to figure out the safest way to make that money last the rest of your life. And annuities do something better than any other financial product, and that is providing a guarantee that you'll never run out of money. They can also do some other things as well, which we'll jump into. But for retirement, it absolutely makes sense to at least do some research and consider your options and adding potentially an annuity to your overall portfolio. So he had that to say last December. Annuities have a primary role for the future of retirement income. I want to give you just one more quote, and this comes from Barry James Dyke. He's written a number of books. I'm highlighting The Pirates of Manhattan 1 and 2. Barry James Dyke, he is an extensive researcher. He dug up so much information on Wall Street and banks, and really uncovered what they're doing with their own money, which was extremely interesting, in how they invest. And it you can read about it if you pick up any one of those two books. But he had this to say, and I thought it was pretty profound. In his research, he says, "My research has verified that General Motors, British Airways, Lloyd's Banking Group, Merchant Navy Pension Plan, Rolls-Royce, BMW, Verizon," goes on and on. These are, I'm sure, companies that you've heard of. Hundreds more of major world corporations have spent billions on annuities to fund and finance their retirement plans. So he's done all this research investigating Wall Street and banks. He's also done research to figure out where these major blue chip companies are investing their money in order to be able to fund and finance retirement plans for their employees. And he goes on to say, the truth is, most annuities are far superior to mutual funds when it comes to providing a lifetime income stream. Pretty profound. So why do people buy annuities? It's because they want greater protection. And there's specifically fixed annuities, SPIAs, and fixed index annuities that provide the greatest type of protection of your principal. Fixed annuities, if you're unaware, basically it's like buying a CD. You get the same interest rate each and every year. So if you're familiar with getting, let's say, a 2% CD, an annuity with the fixed rate works exactly the same way. The only difference really being that the interest that you earn inside of annuity is going to grow tax deferred. So that's better than keeping money at the bank, simply because any money you keep at the bank, you're going to be taxed on it, even if you're not using it. SPIA, that stands for Single Premium Immediate Annuity. If you are looking to turn an asset into income within the next 12 months, generally speaking, a SPIA is going to be the best option because that's going to provide you with the most, or I should say the highest possible income immediately. So that's a single premium immediate annuity. And then there's fixed index annuities, which I'm going to cover more shortly. Now, there is another type of annuity which gets a lot of bad press, and people will tend to confuse it with uh, fixed annuities, fixed index annuities. It all kind of gets lumped in when you hear the horror stories about variable annuities. Um, so let's focus in on variable annuities to better understand them. Now, with that said, I'm going to give an introduction from Susie Orman. You may be familiar with her. She has been pretty loudspoken about being against annuities. Well, I'll just let her say what she has to say. I found this video on YouTube.
Hey, Mary J. from PA. You sent in a question and you want to know from me, why do I not like annuities? How much time you got, girlfriend? Here's the thing. It's not that I don't like all annuities. There are some annuities that I like. I like single premium deferred annuities. I like if you're older and you have a medical condition. Sometimes I like medical annuities. The annuities that I do not like are variable annuities. A variable annuity is like a mutual fund owned by an insurance company. Within the contract, because it's a contract, it's an annuity. Oh, it gets so complicated there. You know, I've written about this in great lengths in my books, on my website, so you can go there and find the information that you want. However, this is what you need to know. Just stay away from variable annuities and you'll be just fine.
All right. Well, that's a pretty strong opinion, but here's the reason why. If you've ever owned a variable annuity, you know that the fees can be pretty high. I mean, on average, what I've seen in my experience is that the fees range anywhere between 3 and 5%. So it's way more than I think anyone should have to pay for managed money. And then on top of that, you also have the ability with variable annuities where you can lose your principal. And if you're going to go into retirement with that type of risk, then it's a legitimate concern to be very wary of variable annuities. So keeping things simple, variable annuities can be really expensive and they don't provide protection against loss. It's just like owning mutual funds. If the market tanks, well, you can expect the values in your variable annuity to also go down as well. If we take a look at some of the fees in variable annuities, you can see how it adds up and gets to somewhere in that average 3 to 5% per year, loaded with fees. You can do additional research courtesy of Google. Just Google variable annuities, and I'm sure you'll find a wealth of information that would discourage you away from variable annuities. So enough said there. Well, one last note regarding the impact of fees. This is a chart looking back the last 10 years, which has been quite remarkable. It's been a great bull run. This chart shows $100,000 invested 10 years ago, and the blue line is what it would have grown to without any fees. So approximately 425,000. And the impact of fees, you can see it's about a 30% hit over a 10-year time frame. So you're taking a lot of risk by having a variable annuity, and you're also paying a lot for what you could basically have in a traditional account without the uh, loaded fees that get added to those variable annuities. So be very wary when you're doing your research on annuities. Ideally, um, I'd say you can do better and you can stay away from variable annuities. And what I would have you do is consider fixed index annuities. The reason why is because fixed index annuities will protect your principal from market loss. If you've never heard the saying "zero's your hero," well, there you go. With an indexed annuity, you can't ever lose money because the market fell. So let's go in a little bit more depth. Now, when it comes to fixed indexed annuities, you should know that there's two basic strategies. There are fixed index annuities that focus on providing income, and then there are other types of fixed index annuities where their focus or their strength is growing your money without risk of loss. So, two main strategies here. The thing about income focused annuities, they provide guaranteed income if that's what you're looking for. If you have an immediate need, or even, let's say you want to defer taking income for a few years, maybe up to 10 years, 12 years, that's completely up to you. But when you go to turn on an income from an annuity, you have the ability to search for the highest payout that you can possibly get. And that's something that income focused annuities, fixed index annuities, do very well. If you were working with me and you wanted to find out which carriers provide the most amount of income guaranteed for when you're going to go to retire, then I would base my search on your age, the amount of premium that you're putting in, because some carriers do have requirements, a minimum requirement, what state you're in, and then real simple, I'm going to shop for the most guaranteed income I can get for you. So that's an income focused fixed indexed annuity. Now, I do talk to people who have multiple assets and they may be retiring with a pension, their Social Security. They might already have enough income to the point where they're just concerned about protecting their principal, and they want an annuity that will allow them to grow that pot of money. And they like the idea of growing it based on what's happening in the market, but they don't actually want their money to be in the market. And so there are annuities that you can choose from that allows you to get the highest potential growth based off of indexed returns in the market, but they come with principal guarantees, which is really powerful because remember, you don't want to lose any money. You want to continue to grow it, but you also don't want to stick it in a bank where it's not going to get anything. If you're concerned about safety, you can have safety and still grow your money with an indexed annuity. And what you're going to want is a strategy that focuses on growth over income. So when it comes to growth strategies, just keep in mind you can't lose your deposit. In fact, you can't lose any gains, any interest that gets credited to your account. Values can only go up, they can never go down. Now, that said, there's different types of strategies. A lot of companies will limit or modify your growth, and they'll do that by putting caps on the growth. With income annuities, you can, like I mentioned, get that guaranteed income. There's also options where, with certain products, if you're concerned about a long-term care event in the future, there are annuities that can offer you a payout that would double your income if for some reason you couldn't do 2 out of 6 activities of daily living. So that is a nice additional benefit you can shop for when you're doing your research for a fixed index annuity. But remember, if you're also looking to grow it, you got to be mindful of how that money is going to grow. And some annuities will have caps on it, Others, and this is becoming more popular, have uncapped strategies. You can still get the income for life and the ADL doubler in case you have a long-term care event. But typically with a growth annuity, what you're going to see is an uncapped strategy allowing for greater growth potential. So in summary there, you can't lose your deposits with fixed indexed annuities. Any gains you get, they're locked in. And it really is going to come down to the growth of the annuity. Are you choosing capped or uncapped strategies? So what's your immediate focus? If you're thinking about your own situation, are you looking at an annuity because you need income? You're trying to plan for your retirement income and you don't want to outlive your money? Or are you feeling pretty secure about what you've accumulated, your streams of income in retirement, and you simply just want to grow that money without risk of loss? Sometimes it's a little bit of both, which I understand. So to wrap up here, we have variable annuities, can be very expensive. You do have the risk of loss. Fixed index annuities, focusing on the income side, you're going to get that no market loss provision. You can shop for annuities based off the highest guaranteed income payouts. And in fact, I'm going to show you that in just a moment. You do have that additional perk where if you do have a long-term care event, some annuities will double your income in retirement. Also, too, I haven't mentioned this, but we talked about how variable annuities will have fees that can average 3 to 5%. Fixed index annuities, on average, the fees around 1%. That's basically what most people pay on managed money. If you have a financial advisor, you're probably paying your advisor on average 1%. Here with a fixed index annuity, you can find annuities that have no fees whatsoever. But if you are including a rider for income later on, typically those annuities will have a fee of about 1%, which is about the same as what you're going to get on managed money. But of course, you get none of the guarantees of income for life and no principal guarantees either. So what you're paying for, you kind of have to weigh the pros and cons, but you get none of the security and peace of mind that you get with fixed index annuities. Going over to growth strategies on fixed index annuities, no market loss, but you also have the uncapped potential. So if that's your focus, you want to really grow that money, you have the ability to do so. And of course, low or no fees. So there's nothing better than no fees, but on average, we're talking about 1% annual fees for a fixed index annuity. That's a lot better than 3.5%. And that's a lot better than paying on average 1% for managed money with no guarantees. So what I'm going to do now, I'm going to close out of this, but just remember, fixed index annuities, if you are searching for a solution in retirement, you want to have something that gives you upside potential with no market risk. You want to be able to not outlive your income, right? You're searching for guaranteed lifetime income, and you want to keep those fees as low as possible. A fixed index annuity can do all those things. All right. So one of the last things I'm going to do here, we're about 20 minutes in. I want to show you a little bit on how I help my clients to shop for the right annuity. I have a scenario here. This is an engine that I use just to let you know, I am independent, so I can work with any carrier, any life insurance company out there. Annuities only are offered by life insurance companies. I use this. This is just one tool I have, but it's a great tool because it shows the people that I'm working with how I can do the shopping for them. I need to know, what their priorities are. Are they looking for income? Are they looking for growth? What their situation is? I'm going to give an example here of someone who lives in California, male. Let's say on average, I'd say the average value account is around 250,000. Some are certainly more, others can be less, but let's say this person is 60 years old and they want to retire at age 68. So we're going to defer taking income for 8 years. And through my financial questionnaire with this gentleman, we determined that he has an interest in obtaining the highest guaranteed income he can possibly get on his 250,000. That may be money that's sitting in a 401k or an IRA, but he's going to do a rollover and he wants the most guaranteed income. And I'm going to show him solutions from different insurance companies. And this is a report that I can run. Just click on report. It'll pull up a PDF. And here you go. Personalized income rider payouts. Came back with 47 different options for his situation. You can see it here, 60-year-old taking income in 8 years. He wants the strategy to be the most guaranteed income he can possibly get on 250,000. And then we have the different carriers. And you can see their ratings here on the left-hand side in green. If there's any fees, typically the fee is going to be around 1%, as I mentioned, because this is an income product. And there you go, income for life. Now, if maybe he doesn't like a B-rated company, the next provider who has the top income for his situation happens to be an A-rated carrier, Delaware Life. So it can be as simple as that. Now that's looking for guaranteed income. There's also a way, if you're concerned about inflation and you want your income to increase, I can go ahead and shop for an increasing payout as well. I mentioned that there's doublers for activities of daily living. If you can't do 2 out of 6 and you want to have an extra pool of money, maybe that's a concern for you. Well, here's a product that gives you a guaranteed income, and then it jumps. You can see it multiplies. If you can't do 2 out of 6, that income suddenly goes from 26,737 to over 53,000 if you have a long-term care event. So for people who don't have long-term care insurance policies or can't qualify for them for some reason, or simply they're expensive, well, here's a way to get an additional pool of money to offset that potential future bill. And of course, I mentioned there are products that have no fees. And there you go. Typically, the products that you do pay a percentage point on, you're going to get more for that. You're going to get more bang for your buck. But that said, there are products out there that have no fees. Some really good ones too. All right, so this is a income approach. If you're of the mindset where you're not concerned about income, you just want to protect the principal, let me show you potential growth strategy, and then we'll wrap things up. So this engine works the same way for growth. Basically what I've given it is, let's look at the last 10-year performance, rank it that way. And here are different products. You can see their hypothetical historical performance over the last 10, 15 years. Doesn't look like there's been any index annuities, just so you know. They've been around for a little over 15 years. So that's why you don't see the back testing go back that far. But we're talking about safe money here. And it kind of blows my mind that you can park money in a growth annuity. Remember, uncapped strategies. So you get to participate in what the market does when it's positive, but you don't lose anything on the downside. And you can see how some of these products have done over the last 10 years. This one with, let's see, this is Equitrust B++. The best 10-year period was actually the last 10 years. The worst 10-year period was 2004 to 2014, and it did 7.5% during that worst case period during that time frame. So you have the ability with growth annuities. If you're not looking for income, you're just looking for growth, you can really grow that money and do so and sleep well at night, knowing that your money is not in harm's way. Pretty powerful. So that's basically it for my presentation. I hope that I've given you a good high level overview. If you're looking for guaranteed income, if you're looking to grow your money with principal protection, an index annuity really is going to be a good option for you to consider. And if you are considering a fixed indexed annuity, please let me know. You can reach me at 925-386-6639, or you can go to my calendar to book a time that works best for you. www.ibc.guru is where you can book an introductory telephone call with me. Appreciate you joining me on the presentation. Please do reach out if you have any questions. Thank you.